there, welcome back to our channel, Finance Experts. Now let's consider a very important fact on the importance of diversifying your investment portfolio and the way you can do this. By diversifying your investments, you may increase profits while lowering risk. What might that signify nonetheless? How can you put money into a manner that safeguards what you have and maximizes your chances of profiting? Are we possible to diversify too much? Let's begin with the fundamentals and examine why diversifying across a variety of categories of assets is important. One of the essential components of an excellent investment plan includes diversification. By diversifying your assets across several asset classes, you raise the possibility that perhaps some of them will perform well despite the fact that others don't. What is the diversity of an investment? The most straightforward and successful method of lowering investment risk is the diversification of your portfolio. To reduce susceptibility to more than one asset particular risk, a portfolio with adequate diversification uses a variety of asset classes and investment instruments. Through diversification, haphazard risk incidents can be balanced out within the investment. Consequently, significant gains can assist with balanced losses in various industries. When all of the investments that lie beneath any portfolio are uncorrelated, they react to market pressures differently. Sometimes in opposition to one another, you reap all the advantages of diversifying your portfolio of investments. We'll start with an example that will show you why investing in a variety may be advantageous. Consider making investments in a pair of businesses, one of which makes healthy soft drinks and the other of which builds houses. Since both firms are performing well, you make the choice to acquire shares in all of them by spending $20,000. Why should we diversify our portfolio of investments? We cannot all be professional investment investigators, and neither do we enjoy the resources to devote our spare time to the business of distributing capital. But everyone aims to develop the best plan possible to increase their money as they move closer to financial freedom. For this reason, the majority of investors should incorporate diversity into their long-term investments plan. Handling of risk. Every business learner is introduced to one of Harry Markowitz's most significant and influential economic ideas throughout the first years of their college degree. This theory relates to finance and investing. Such a way of thinking promotes financial diversification and emphasizes the advantages of not placing all your eggs in the same basket. Investments are subject to both systematic and unsystematic risk, which includes market hazards like rates of interest and downturns along with problems unique to each venture, such as bad product sales or management changes. The essential point from this idea is that good portfolio diversification does not avoid systematic losses, but it may attenuate, rather than remove the unorganized danger from an investor's portfolio. Maintaining capital. Any investor should begin with the primary goal of capital conservation. Some investors who are nearing retirement with goals focused on the safeguarding of wealth and investment diversity may assist safeguard your resources. Not all investors are yet in the phase in their lives where they are accumulating cash. By reducing an investor's exposure to a single financial loss, diversification achieves this. Although it may seem like apparent sense, many investors design strategies that fall short of serving them with sufficient protection from long-term wealth loss. When an investor wants to safeguard their portfolio against losses, diversifying their assets becomes an essential component of support. Generating a steady income. Selecting assets with diverse responses to similar economic circumstances is the cornerstone of a well-diversified portfolio. Someone who invests won't experience the peaks and valleys of holding only one strong flying stock, but additionally, they aren't going to receive the abnormally high gains that come with it. In reality, the investor is only partially exposed to the overall volatility of every single investment while still earning the average return on all the assets they are investing in. For people with a limited investing horizon, this is particularly significant. Diversification strategies for your investment portfolio. Investing in items with inherent variations among them in the sense of risk profiles results in diversification. Investing in assets that differ throughout asset classes, sectors, industries, sizes, and income profiles is one of the most popular strategies to disperse risk within the investing landscape. Helps individuals reach investment objectives. To achieve long-term investment objectives, such as saving for retirement, diversification is crucial. You may control risk and take advantage of the potential growth of various opportunities for investment by maintaining a diverse portfolio. In the end, this might assist you in achieving your investment objectives. Even experts who have access to many sophisticated algorithms still struggle with performing them effectively. Instead of figuring out when a higher phase will start, followed by frantically trying to acquire additional shares before prices begin to rise once more, it may be preferable to concentrate on making absolutely certain you have deposited enough when one does. A mix of assets helps guarantee this, given that even if one industry performs badly, another may perform adequately to provide gains worldwide. If a single class of assets depreciates in value relative to others as well, others may perform well sufficiently to produce losses overall. To summarize, a key tactic for minimizing risk and optimizing profits is diversifying your investment portfolio. It increases returns, offers stability, lowers risk, and helps achieving financial objectives. You may lay a solid basis for reaching your financial goals in the future by diversifying the assets you hold. As an example, if your whole portfolio consists of investments in stocks and the stock market falls, it might completely wipe away the value of your holdings. However, if you have a varied portfolio that includes real estate, stocks, bonds, assets, and perhaps even some cash, it may be less probable that all of them would lose value when the market declines. Any investor should understand the importance of diversification. You may lower your chances of losing money in just one stock or market category by diversifying your investment choices and distributing your assets across many asset classes. Furthermore, you'll raise the possibility that maybe some of those investments will prosper even if others don't. We hope that our audience has received a very good understanding of what is meant by investment diversification, why you should use diversification for your investment, the importance of diversifying your investment portfolio, and how it works for your investments. Thanks for being to the end of the video. Don't forget to like, share, subscribe, and tell us what you think about this video below in the comment section. Thank you for watching, and we'll see you in the next video.